Buy low, sell high. We've all heard this before. But what do you do in an economy like today where markets are setting record highs, even though many people are still concerned about the economy, and now investors are hopeful that Trump is going to save the economy and boost the stock market? So is this the time to double down and buy even more? Or is this the time to sell high and cash out of your profits? In this video, my goal is to break all of that down. That way you can be a more sophisticated investor and accelerate your wealth through a Trump presidency. Now, of course, I gotta remind you, I'm just a random guy on YouTube. Investing has risks. You are never guaranteed to make money when you invest. In fact, you will lose money at some point. So make sure you always do your own due diligence and never blindly trust a random guy on YouTube. And with that, let's start by studying history, because while history doesn't exactly repeat itself, it does rhyme. So let's dissect what happens to the stock market when a Democrat is president versus when a Republican is president. Take a look. This is a chart that my team published in our Market Briefs Pro newsletter, which shows what happened to the stock market, more specifically the S&P 500 under a Democrat, which is blue, versus a Republican president in red. And what you can see is that under a Democrat president, we've seen the markets go up and down, and under a Republican president, we've also seen the markets go up and down. Now that might seem obvious that markets go up and down regardless of who is in the White House, but let's get a little bit more granular and let's take a look at what happens to the stock market historically the year after an election. Take a look. Again, this is from our Market Briefs Pro research, but what we found in our research is that the year after an election between 1944 to 2020, the only time we saw the stock market fall, the year after an election, was after the 2000 election when the stock market fell in 2001. That was during the dot-com bubble, and interestingly, the biggest year for the stock market after an election was after the 1996 election when the stock market rose by 31% in 1997, and that was after Bill Clinton was re-elected to the White House. Now, of course, past performance does not indicate any sort of future performance. We don't know what's going to happen next year, but what this does tell us is that if you are a long-term investor, meaning if you're investing in things like the S&P 500, you're investing in the stock market with index funds, mutual funds, ETFs to give you broad exposure to the market, you are investing for the long term. You are not investing for election cycles, which means if you are this type of long-term investor, what's happening in the White House does not matter. You keep doing what you're doing to take care of your own house, because now you are a long-term investor and you can ignore all of this noise. But what a new president does do is decide how the government will spend its money. Let me show you what this means practically. In 2024, our GDP is expected to be about $29 trillion. This is the size of our economy, and GDP is a measure of all spending that happens in our economy. So when you go to Chipotle and you buy the extra guac, or when Walmart buys the avocados, this is the spending that makes up this $29 trillion. But the hidden part to this is the largest spender in our economy is not Walmart, it's not Jeff Bezos, it's our government. In fact, our government spends about 22 to 29% of our GDP. So if government spending is making up the largest portion of our GDP, about a quarter of our GDP, that means that the person who is in the White House can impact certain parts of the economy depending on who the person in the White House wants to give contracts to and wants to invest in. For example, Donald Trump has talked about deregulating and investing in the oil and gas industry. He's talked about deregulating and investing in the financial services industry. He's talked about investing in the military. He's talked about deporting many illegal immigrants, which is good for private prisons. And he's also talked about investing in space exploration. So, if the person in the White House can help direct some of this spending that can impact certain industries, certain sectors, and certain companies and stocks more than others. Now again, if you are a long-term investor and you're not investing in individual companies, none of this matters. Because now you just keep doing your thing. You just keep investing in the S&P 500, you let the markets do their thing, you let the markets and the economy do their thing, and you know markets are gonna go up and down, and you just ride the wave. But for some of you, we'll call it more sophisticated investors who want to be more involved, who don't just want to invest in ETFs and the S&P 500, this is where now studying these types of what I call government shifts can help you find new, unique investment opportunities. Now, I am doing a whole workshop on this. on November 19th at 10:30 a.m. Eastern Standard Time. It's completely free, it's live, and it's virtual. Then if you'd like to join me, where I'm going to be going over different ways that you can profit from a Trump presidency. This is a workshop for stock market investors who want to understand how the new Trump regulations can impact certain industries and certain stocks. So if that's something that you're interested in and you want to learn more, you can join me on this free workshop on November 19th at 10:30 a.m. Eastern Standard Time, and I have the link for you to join down in the description below. But this is where you have to start by understanding what type of investor are you? Are you a trader? Or are you an investor? And if you are an investor, what kind of investor? Are you the type of investor that wants to invest in individual companies? Or do you just want to invest in the markets? And you have to decide what's right for you, because at the end of the day, the mistake that so many people make is they lose money, not because they bought the wrong thing, but because they had no strategy in the first place. The stock market, we know, historically has grown by around 10% a year for the last century. That means if we take a look at the last 100 years, the markets have gone up, they've gone down, but on average it has grown by about 10% a year. Yet so many people lose money in the stock market. We all know many people who talk about the stock market being rigged, how the stock market is a scam because they've lost money in the stock market. But if the stock market has grown by around 10% a year for the last 100 years, why are so many people still losing money in the stock market? It's because they go in thinking, I am a long-term investor, and you buy this company, and then 2 months later you see it down 6%, now you panic and you sell. You thought you were going to be a long-term investor, and then you became a day trader or a trader just because you saw the market start to go down. And so this is where you have to balance your investing strategy with the investing psychology, because I'm going to give you the reality of what happens when you invest your money. This is 100% facts. Our economy goes up and down. We have seen a recession pretty much every decade for the last century, period. Along with those recessions have come market crashes, which have come decade after decade after decade. Now, despite these market crashes, despite the recessions, the markets have still gone up over the long term. And that means if you are just investing in the market, like you're investing in the economy, for example, the S&P 500 is a group of the 500 largest companies in the stock market. If you are investing in the S&P 500, you're essentially investing in the economy. If you're investing in the economy, well, you're going to see ups and downs, but what we have seen is over the long term, the economy has grown. If you are investing in individual companies, now again, we have seen the economy grow over the long term, but some companies have gone bankrupt. And if you don't know how to analyze your investment, or if you don't have the psychology to hold that investment, then you're going to be the person that's paying for somebody else's profits. And this is where you have to understand your strategy. Are you a trader or are you a long-term investor? I don't talk about trading because I am not a trader. That's not a game that I play. It is gambling to me. So I am not a trader. I don't like talking about trading because I don't want to talk about or teach something that I don't understand. Now, when we talk about investing, investing is where you want to own an investment for at the very least 1 year, if not many years or decades. And there's two ways to go about this. You have what I like to call passive investing or what I like to call active investing. Passive investing is you're investing in the economy. You're investing in ETFs, mutual funds, and index funds that give you broad exposure to the economy, and you are going to keep investing your money every week, every 2 weeks, or every month. And you do this no matter what. You do this no matter who's in the White House. You do this whether it's raining outside. You do this whether it's a market crash or a market boom. No matter what, you just keep investing your money. I do this, but I also do this. For this long-term passive investing, I have a system where every Wednesday, money leaves my checkings account and is automatically invested no matter what. And people always ask me, Jaspreet, why Wednesday? Just because it's in the middle of the week. There's no secret sauce to this. This happens no matter what, whether the market's up or down. Then I have a separate strategy where I'm looking for these types of what I call market shifts or unique investment opportunities that I believe will give me a good investment for the long term. Now again, this one requires more work because not only do I have to find a good company, I want to find something that I believe is a good deal, that I believe is going to be worth more money in the future. So it takes more work and it takes more time. And it's also more risky, but it comes with more potential upside because this company that I invest in could potentially go bankrupt. And if I invest in the company and it goes bankrupt, I lose everything. But I understand that risk and I'm willing to put in that work because that's something that's interesting to me. But it's not for everybody. Now here, what I like to look for is what I call market shifts. A market shift is now an opportunity where I think there's opportunity in the future to buy this thing today. Now, there's many different types of market shifts that you can look for. The thing that we're talking about right now is a government shift, because we know that the person in the White House can control a big chunk of spending, or they can help influence that big chunk of spending, which can help certain industries, certain sectors, and certain stocks. And if you understand this, well, then this can create an opportunity. But not every company in those industries is going to benefit. This is where your financial education comes in. For example, we know that Trump wants to deregulate oil and gas. Does that mean every oil and gas company is going to profit? No. Some will profit more than others. Some may not run their company very well. Some might not be very smart with their cash. We might even end up seeing a recession. And these things can hurt the companies. And this is where you have to understand the risks with what it is that you're doing. And then you have to understand what is your goal with investing, because that's going to help dictate where it is that you're investing your money. For me, for the bulk of my investments, especially here with my passive long-term investments, my goal is cash flow. I like to invest for cash flow because that means I can own this thing and get paid for owning this thing, and I don't have to sell to get paid. That is my investing strategy, because I prefer cash flow, because I can live off of my cash flow. That's the way that I invest. That's why real estate is the largest asset outside of my business in my investment portfolio, because when I invest in real estate, I'm investing for the cash flow. When I invest here, I'm investing for the cash flow. When I'm investing here actively into companies, it's for growth and sometimes cash flow as well. The reason why I like cash flow is because, well, I can get paid without having to sell. Then I can work to stack the cash flow. Now, you have to know what's right for you. You have to know what your goals are. The problem that I am seeing with investing today, it's a double-edged sword, is that everybody is getting involved with investing, which is a good thing. And investing has become so much more accessible, which is a good thing. But then you have the downfall to this, which is investing has become so accessible that people are now doing it without understanding what they're doing. That's kind of a problem, because everybody's going to make mistakes, which is okay. But then the second problem is many brokerages are now making it very easy for you to invest or trade on margin. They actually want you to trade because they're going to make more money off of you, but many brokerages make it very easy for you to invest or trade on margin, meaning with debt. So if you don't know what you're doing, that's a problem, but nobody starts by knowing what they're doing. I mean, you have to start somewhere. So it's not that big of a deal, because everybody starts without knowing what they're doing and they're going to make mistakes. No big deal. But then you get margin, which kind of amplifies those problems, because now that means that you can start trading or investing without knowing what you're doing, without your money. And now that's the second problem. And then the third problem is when you couple this easy accessibility into trading and investing with margin with a whole lot of financial news, which is created to drive emotion, that's where you start to see more problems. Because nowadays, the reality is everything has become emotionally driven. The traditional financial media companies are in the business of selling clicks. They want to sell you emotion. They want to tell you that the stock is going to go to the moon or the stock is going to crash, and it's either this all or nothing, that either super exciting or super bad. Trust me, I know. I own a company in the financial media space. Briefs Media is a financial media company. That's why we created Market Briefs, which is my free financial newsletter, because our financial news is driven through one newsletter, so we don't have to give you this sensationalist, emotional news. It's a free newsletter that breaks down everything that's happening. That way you can get an unbiased breakdown of what's happening in the markets. But I can tell you from working in this industry that many companies profit by selling you this greed or this doom and gloom, because that's what's going to get you to click. And if you don't click, the companies don't get paid. And if the companies don't get paid, the writers aren't making money, and the company is not going to stay in business much longer. That's the way it works. Now you can hate it or understand it. And this is where I want you to understand what's happening, because the reality is there's going to be a lot of emotion. High emotion, greed emotion, and also scared emotion. And we know that recessions happen. We know that market crashes happen. We all heard buy low, sell high. But this is where I want you to take a step back and understand, number one, nothing can go up forever. Number two, what is your investing strategy? And once you understand that, you can start to dig a little bit deeper into what it is that you want to do. If you have made great investments and you have seen huge profits and you want to take some money off the table, there's nothing wrong with that. People will make you feel bad for cashing in on profits. But what you have to understand is a profit is a profit. It's better to make a profit than not. And yes, you can feel bad if you cash out of a big profit and then it goes up a whole lot more in the future, but you have to start by knowing what is your goal. And don't just sell because you're scared or because you've made a lot of money. Kind of have a strategy here. What I mean by that is, did you hit your investing goal? Is this company now overvalued? Do you have a better place to put this money? Is something wrong with this company? Is that why you're selling? Or are you just doing it out of emotion? And this is where, what I always like to say, the best financial decisions are not made out of emotion. They're made out of financial decisions. And this is where you got to be able to cut through the noise, cut through the emotion, and now focus calmly on what it is that you want to do and just be comfortable with your decision. Be comfortable with the risk. Everything is a risk. Investing your money is a risk. Not investing your money is a risk. Buying an investment is a risk. Not buying an investment is a risk. Selling your investment is a risk. Not selling your investment is a risk. You just have to understand what is the right risk for you depending on where you are in your season of life and in your season of investing. And my goal with this video is to help you understand, hey, we know that there's going to be a new president in the White House come January. We know that there's a lot of excitement behind that, especially with Wall Street. We know that Trump wants to invest in certain industries and he wants to invest in certain sectors, and those can help those companies make bigger revenues, potentially bigger profits. All of the companies, well, no, but the general industries. That's what we know. We also know that despite who wins the White House, we have seen the stock market rise historically. We also know that markets go up and down. Now that you understand that, we know that markets are at an all-time high right now, but we don't know what's going to happen in the future. All we can do is take a look at history, and once you understand history, now we know that despite market crashes, despite recessions, markets have still gone up. And if you want to be able to capitalize on the upswing, you have to know your strategy. If you're investing in individual companies, then maybe you need a real reason to buy a stock at an all-time high. You have to understand, what is that shift? What is their unique proposition for next year, the year after that, and the year after that to allow them to keep rising? But if you're just investing in the markets, well, you just keep doing your thing. You keep buying when markets are high and you buy when markets are low. You keep doing that, and what's happening in the markets, what's happening in the economy, what's happening with the White House does not matter. But when you're investing in individual companies, now you got to be a little bit more sophisticated and understand, is this a good time for you to buy? And is this a good company for you to buy? Is this a good industry for you to buy? And how long are you buying for, and what are your goals? That's why you have to be able to dig a little bit deeper in your investments. The IRS just released their new tax brackets for 2025, which is why in this video, I want to go over what these new tax rates look like so you know what to expect. And then I want to go over how you could potentially pay less money in taxes legally. This is what the tax rates look like. These are the numbers if you're filing as a single person. These are the numbers if you're filing married and jointly.